welcome back. So this morning it is 6:17 as we kind of get the day going. And I talked about just a moment ago that tomorrow at noon, we're going to release our podcast from Caroline Baum. Of course, Caroline Baum has been writing for Market Watch forever. She's a big Fed watcher. And so we had a very, very good conversation yesterday. Now, we're going to release the full podcast tomorrow at noon, and this will be prior to the release of the Fed meeting. The Fed will have their meeting, their two-day meeting. They will come out immediately. They're now going to have a presser following every meeting. So the fact that we didn't get enough communication before, we're now going to get even more communication from the Fed. After every meeting, they're going to have this presser where they talk about what they talked about during the meeting. So this is going to really provide the markets a whole lot more ability to be volatile as we try to parse through their usually cryptic language of what they're actually trying not to say while they're trying to encourage the markets to stay positive. And remember, think about this. The Federal Reserve is never going to tell you the truth. They can't. If the Federal Reserve I've said this before, but if the Federal Reserve came out, so let's say that Jerome Powell came out tomorrow afternoon and said, you know what, we've looked at all of our data and all the stuff we've been doing with QE and low interest rates isn't working. The economy's about to be in a recession. Immediately, the market would dive a couple of thousand points. That would impact consumer confidence. Consumers would pull back. And guess what? You would be in a recession pretty quickly. And the Fed understands this. The Fed understands the power and control they have over the financial markets. They're also really held hostage by the markets in and of itself. And this is why after that decline that we saw in October, November of last year, December, we saw such a quick change by the Federal Reserve into this different stance of them being a lot more hospitable towards the markets. In fact, I've got an article out today on the website right now, just released it this morning, talking about this very thing, saying, can the Fed in their decision-making process here over the next couple of days, can they wind up actually, trying to save the bull market here? And this is the big challenge for the Fed. And the one important thing here is that Jerome Powell was supposed to be this different animal. He was supposed to be the guy that was not of the same ilk and breed that we had with Janet Yellen and Ben Bernanke and Alan Greenspan before that. And something that we talked about yesterday was the fact in 2013, when Jerome Powell was just governor of the Federal Reserve, he wasn't one of the head guys, right? He wasn't a president. He wasn't, the head of the Fed. He says, I have one final point, which is to ask, what if the economy does not cooperate? He says, we're at $4 trillion in expectations for the balance sheet now. And if we have two bad employment reports, that the markets are going to begin to expect $5 trillion on their balance sheet. And the idea that the Fed governors have all echoed is that we're now captive to the market. And he says, that's somewhat chilling to me. And it's interesting. So when Jerome Powell became the head of the Fed, because of that statement and other statements that he made, obviously, people believed that he was going to be different, that he wasn't going to worry about the financial markets. Well, a 20% decline in the markets changed that perception very quickly, and the Federal Reserve is now very captive of the markets. And as head of the Fed, it's always different. It's always easy to criticize the boss until the boss says, okay, fine, you do it. And then all of a sudden, you find out how challenging it is to run a business or be the head of an organization or whatever it is. It's never as easy as it looks like from the armchair, being a Monday morning quarterback of your company or whatever it is and say, well, I could do a better job. It's a very different story when you're having to make the financial decisions and try to grow the business. So, but same thing for the Fed. As a governor, it's easy to sit back and criticize what's going on. But once you're the man making the final decision and once you're the man being held accountable for those decisions, it is a very different process. And what Jerome Powell has found out very quickly is that he is indeed captive to the financial markets. But yesterday we talked with Caroline Baum. I'm going to give you a little bit of a teaser here for an interview. I asked her yesterday, I said, well, we've had a tremendous rally in the market over the course of the last 3 and 4 weeks. And based upon the idea anyway, is that all the support to the markets for there. But the real question, is that the case?
I would say that the stock market has huge amount of leverage over the Fed. That's probably not a message it wants to telegraph, But, that Mnuchin comment about the banks are, can all, meet their, depositors' demands. I mean, talk about pouring gas on a fire.
And that's right. And again, we saw a tremendous amount of support coming from both the federal government as well as the Fed. Of course, remember, right after the decline in December, Steve Mnuchin came out. And this was very interesting. It's something that we talked about is, it's unusual for the Secretary of the Treasury, mind you, to make comments about markets. That's one thing. That's very unusual for that to happen. The second thing is very unusual is for him to come out and say, hey, I'm going to call all the major banks and assure them that there's enough liquidity. Now, that, too, is a very unusual statement, and you only would do that kind of a statement if there was indeed a problem. You would want to assure the investing public that, hey, don't worry about it. We've got liquidity backstops covered. Now, when was the last time we had a liquidity problem? This was back when Bear Stearns failed in early 2008, before Lehman. Bear Stearns was the kind of the catalyst and was the straw out there that we should have been paying attention to, and we didn't. We dismissed it, and of course, ultimately wound up in a very large financial crisis down the road. Lehman became the poster child, but really it was Bear Stearns that started the dominoes falling in that whole process. And at that point, nobody came out and said, hey, don't worry about liquidity. We got liquidity covered. All of a sudden, we have Deutsche Bank, who is now the poster child of potentially credit-related issues on a global scale, not just domestic as we saw with Bear Stearns. And you've got the Treasury the Secretary of the Treasury coming out to assure investors that there's plenty of liquidity, nothing to worry about. That in and of itself should be a warning sign. But it wasn't that, but you also had Donald Trump and the administration coming out saying, hey, don't worry, trade talks are going sweet. Well, news today coming out, trade talks not going so well right now. In fact, China is not going to back off their technology demands. And again, we've talked about this on the show repeatedly. That is the one area that China is not going to give up ground on, period. And that may very well be the sticking point for any type of trade talk to really move forward and to make significant progress, because Trump is wanting to demand deep structural changes in China that, well, look, they're communist. So they're not capitalist. They're a state-run economy, and these deep structural changes that Trump wants are simply not going to happen. And that could very well be kind of the sticking point for what's happening with these trade talks. So expect some delays there. But here's the point of all this, and as we get to this, is that there have been a lot of talk over the last couple of weeks to help spur this market rally that we've had and enjoyed, and it's been great. But the reality is that a lot of this talk is simply just that. We're not seeing actual progress being made. And more importantly, keep a watch on earnings. Yes, companies are beating earnings right now, but we have the lowest beat rate that we've had right now on company beating reports in like the last 15 years. And more importantly, that beat rate, even as poor as it is based on substantially lowered earnings expectations. In fact, we are probably going to start to see an earnings recession over the course of the next couple of quarters. So again, things may not be as rosy on the surface as we've been led to believe. But when talking with Caroline Baum, again, we're going to release this full podcast tomorrow at noon. So if you go to Lance Roberts Show at YouTube, or simply go to our website at realinvestmentadvice.com, you can get the full podcast. But I talked to her about it's hard to understand understand this, and talking about the fact that nothing's really changed.
Short of a change in economic fundamentals, I don't remember a change in tone from the Fed in this short a period of time. I mean, by the time Powell and his two predecessors, Bernanke and Yellen, did a little tete-a-tete at the American Economic Association conference on annual meeting on January 4th, I believe, it was all sweet talk, sweetness and light. And yeah, the Fed, murders expansions, and patience is the order of the day, and we can afford to be patient. And it was if a memo went out and they changed their tune.
And that's absolutely right. Of course, that change to the tune came with the fact that we had this decline in the markets of 4.4% last year. And again, think about that one more time. And I said this earlier. The market was down 4.4%. first time we've had a decline that big in a decade, and it was just 4.4%, and yet all the alerts have gone out. And that should at least clue you in to the fact that there's probably more of a problem here than we realize, because, again, you wouldn't make this dramatic of a change, even in tenor or tone, unless there was something more worrying underneath the surface. But again, you're not going to be told that. As I said before, the Fed's not going to come out and tell you, oh, we're concerned about this. They can't, because of the impact on the financial markets, which ultimately leads to a drop in consumer confidence, which, by the way, is already showing signs of weakening. But and again, this is this idea. And the question was, was this just a trial balloon? Is this whole conversation by the Fed just simply a trial balloon? I
went back and I reviewed what the various officials have said, in the month of January, since the tone change, since the new year, sweetness and light, providing succor to the markets. Most of it was benign, just saying about, nothing is on automatic pilot. If the facts change, I change my opinion, that kind of thing.
Sure.
The only person who had something interesting to say was Esther George, president of the Kansas City Fed,
yes, ma'am.
Who basically said, we don't have an effing clue as to how this quantitative tightening work.
And there we go. So tomorrow, that full podcast with Caroline Baum being released at noon. So be sure and get by our YouTube channel, The Lance Roberts Show. Subscribe there for all of our latest podcasts. We've got one coming out very shortly after that on why retirees should worry about bear markets. Those are all coming out on our podcast channel. You can also pick up all of our podcasts and all of your favorite podcast listening devices at our website. Simply go to realinvestmentadvice.com, click on the podcast tab. You'll find them all there. Coming up after the break, we're going to talk with Richard Rosso about our upcoming event on February the 9th. You'll certainly want to subscribe for that. You can get registered at the website, realinvestmentadvice.com or thelancerobertsshow.com. Either one will get you there, but you can get registered for the upcoming event February 9th at the Hyatt Centric in the Woodlands. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at lancerobertsshow.com.